We have a treat for you today. We have found a way to get a CPA out of his office at the start of tax season. It's easy to get them out of their office at the end of the tax season, but hard at the beginning. And this is a surprise for you. What has changed going in 2018 in the tax bill versus what was going on last year? That's what we're about to talk about today. Tune in.
Welcome to the Wealth Without Wall Street podcast, your guide to understanding how to get out of the Wall Street rat race and start your own mailbox money lifestyle. Now, don't let the handsome Southern draws fool you. These financial minds are teaching our country to enhance savings, increase cash flow, and create passive income, all without the help of Wall Street. Are you ready to break through? Here are your hosts, Russ Morgan and Joey Murray.
There's some certain words that are no-nos, like a four-letter word, Joey. But today's three-letter word may be worse than any four-letter word you've ever said.
That is right. We're talking about the greatest eroder of American wealth that anybody knows about.
The one thing that every single person is affected by. Every single person.
That hole in your pocket.
What are we getting into here?
Well, I'll give you a hint. We're talking about something that happens in April.
TAX.
Taxes. Everybody's got questions about taxes today, don't they, Russ?
Well, I know I do because we just went through the greatest tax reform in like the last 25 or 30 years. And thankfully, you and I don't have to try to figure out the answers to that because we're bringing in an expert.
That's right. Clay Hagler is joining us today, our CPA extraordinaire. He
is extraordinary, right? I mean, the guy has, a team of CPAs that he works with. Thankfully, he's come and talked to many, many conferences we've done. He thinks outside of the box. This guy is not your traditional CPA, one, because he actually has a personality. I mean, that's pretty rare in the CPA community.
You'll definitely pick that up in today's interview, but you're also going to pick up some great nuggets.
Yeah, he's going to share with us in this tax reform what deductions were staying and which ones are out the door.
You may be surprised on that one, by the way. And don't forget this little bonus. I thought this was interesting. How about the worst asset you can own at your death being the 401k?
That was pretty interesting that he said that. He also said that he was okay with the fact that tax reform didn't go back and change the tax bill to be so simple that you could fill it out on a postcard, right? Listen into today's episode. You're going to get a lot of nuggets. Welcome, everybody. We are sitting here with CPA extraordinaire Clay Hagler, a good friend, someone I have known for probably 10 years now, and we've worked on a lot of different projects. And I am so glad, Joey, that we found somehow, some way to get him to come in and share just a little bit about what went on in this new tax bill. And I'm just thankful to you, Clay, that you're willing to sit down with us and open up. And I know there's things you can say and you can't say, and we're going to try to tell everybody out there that any input that we give you, always go out and seek your own advice on this. But we're going to tell you some great nuggets.
No doubt. I mean, we are constantly getting questions around this, so I can't thank you enough for being here, Clay. So welcome.
Oh, you're welcome. And yes, and y'all are right. I bet you I've fielded at least a dozen phone calls a day for the last 3 weeks about this. So it's definitely a subject on a lot of people's mind.
Hot topic.
Yeah, well, I mean, Clay, as you know, this isn't a surprise or shocker to you. Everybody that's listening to this right now is trying to figure out, how can I save taxes? I don't want to pay $1 more than I have to. And I really would like to know, how did this new, supposed tax reform that everybody's been talking about, in simple terms, how does that affect me?
Well, you use the word simple. There's nothing really simple about it. It's probably one of the largest tax reforms we've had in a long, long time, and definitely has given us as the CPA profession some job security for sure. So it's not. Not very simple.
You're telling me the idea of being able to fill out our taxes on a postcard was not something that you were signing on to?
No, that didn't happen. I heard my tax professor always in college, years and years ago, always said that wouldn't happen as long as we had politicians, and I think that's what we can see see happened here.
Well, and Clay, I love you too much. I mean, you're a client of ours. We need you making money. So, I mean, when it comes to complication, I think in that regard, I'm rooting for you, right?
Yeah. So, I mean, we could spend, 2 or 3 hours. I mean, we've already been to seminars and webinars ourselves that the AICPA puts on for all the fellow CPAs so that we can try to digest everything that's happened as well. So, I mean, and we've been to 4-hour classes already on this. So, I mean, you could spend almost a whole day on it, but, I just let me know what y'all kind of want to cover. If y'all just want to cover some of the highlights for entrepreneurs, stuff like that, we can do that.
Yeah, I mean, absolutely. Entrepreneurs are the main people that we're talking to on a daily basis. These are the guys that have that constant just feeling of having to write that big check. They're not an employee that is sitting there and just having it kind of drained out of their paycheck every, pay period. They're constantly having to write that check. So anything you can help us understand about how this is going to affect them. You've already said you've had a lot of calls. What are those calls like? What are the main things people are wondering from you?
The main questions we have seemed to fielded were basically around just the tax brackets and the rates. People had questions about that. And then they had questions about certain itemized deductions that were changed that really hit our more wealthy or high income earning clients. And then, of course, most of them have some type of involvement in a business entity, and they want to know about this business pass-through deduction that is going to affect so many of them. So those typically are the three main things that we have seemed to field questions on in the last 3 weeks.
As we dig into this, Clay, just on a baseline level, do you feel like small business, I don't want to say small business owner, but the individual who's running, say, a $250,000 a year revenue all the way up to, say, $2 million revenue business, is their tax bracket or the amount of taxes they're paying in general going up, going down, roughly staying the same? Is that too broad of a question? Can you even answer that?
Well, it is broad, and I will say that each person will need to do their own projections to see how it affects. But looking at it, it does look like you will have a benefit and a tax reduction for most of these small and medium-sized businesses in some shape or form.
Okay. Well, that's good. I mean, if I'm sitting here, I mean, obviously our business falls into that category, and it's kind of thinking, okay, well, obviously, hopefully there's some extra dollars at the end of the day that, I can use and I can reinvest and all these sort of things. And I want to make sure that we're touching on the topics that, like we're fielding these same calls, and it's, look, I need more control. I need to understand more about what's going on out there. Can't we really simplify this process so that way I can get back to work? I can go do the things that make money.
Right. And like we told our clients that we discussed this with over the last 3 weeks and are still discussing it today as we're preparing their 2017 returns. There's not a lot you can do for 2017. All the effects primarily go into effect in 18 and forward.
Yeah.
But there is some opportunities possibly for some of these small businesses to look into that we can discuss. And I mean, I don't know how y'all want to do this, but do y'all want me to just go ahead and kind of lay out some of the main questions?
Yeah, I would say, like, what's
specific?
The top one? What's the number one question that you're answering for your typical client? Because that's who's listening to this, by the way. So, I mean, what is the number one thing that's going to affect the person typically listening to this?
Well, there's really two.
Okay.
Let's look at just the tax rates. The first one, tax rates, of course, they have decreased. And then some of the brackets or the thresholds, as maybe you could use in the layman's terms, that get you into a higher rate have increased as well. For instance, I'll just give you a quick example. The highest tax rate used to be for a married filing joint was 39.6%. In 2017, you didn't get into that 39.6% bracket until you hit $470,000 worth of taxable income. In 2018, under the new tax reform, the highest bracket now will be 37%, and the threshold for you getting into that bracket being taxed at 37% is any income over $600,000 will now be taxed at 37%. So not only did the highest rate go down in this example, but it also, you don't get to that highest rate until a later point.
Much higher point in your income,
yes.
Now, in order to do that, they probably took a few things away.
They did, and I'm glad you brought that up because they had to level the playing field somehow.
Right.
Right.
It's a give and take.
Yes, it's a give and take, and that's how it occurs. So what they've done is they've taken away some of the standard. I say not standard. That's a bad terminology to use. They've taken away some of the itemized deductions.
Okay.
One of the biggest ones that our clients are talking about is the state tax deduction.
Oh, okay.
Previously in 17 and prior, you got a deduction for your state taxes paid. And if you're a high income earner, that could be a significant amount. I mean, you also can imagine if your state of Alabama's, 5%, but can you imagine people in California and New York? Those are the real ones that are really in upheaval about this because they're losing that deduction. So in other words, if you paid $50,000 in state taxes, that was going to reduce your taxable income on the federal level by $50,000 approximately.
Now, and I'm asking you a question that I don't know if you know the answer or can help him, but like, what about the person who's listening to this and say Tennessee or Texas that doesn't have a state tax? Then I guess that they're unaffected in that regard?
Yeah, it won't affect them as much. They still limit the overall because the tax deduction you get in 17 and prior was you got to deduct any state taxes you paid, any real estate taxes you paid, and any personal property taxes you paid.
Right.
Okay. So what they've done is they said, hey, we're still going to let you deduct that, but we're capping it at $10,000.
I got you.
So those people, depending on what their real estate tax situation is, those will probably be unaffected by that change in the law. But you're looking at Tennessee, Florida, Texas, state of Washington. There's just not that many of them that,
Well, here's one of the ones that I'm a little bit frustrated about that Joey came in here and told me the other day is that when we go to lunch and we sit down and we talk about business, because we don't talk about anything else. Joey doesn't like football, so me talking to him about football is useless. The fact that I'm an Auburn fan doesn't really help anyway if he did talk about football. But he tells me that, Clay, I no longer can take him to lunch, talk about business, and write that off in 2018. Is that true?
Well, that's some of the things that have gotten a lot of confusion.
Okay. Well, clarify for me, please.
Yeah. Everybody thought they took the meals away. But what they've really taken away is the entertainment deduction. So in other words, if you take somebody to play golf, which is still a big deal. I mean, that's how we network. You take somebody on a fishing trip. Yeah. You give somebody football tickets and take them to a football game. Where that used to be deductible, it is no longer deductible.
So the meal that we eat at the turn is deductible. The golf balls that Joey loses in the woods are no longer.
Whoa.
Yeah, that is correct from how we understand it, yes.
Man. So, just for anybody that's listening, Russ has that very backwards. We would be reloading for him, okay? Not for me.
Yeah, I got you. Well, and one thing else in that, I don't know if y'all have taken advantage of it, but so many companies are going to this because they make their staff more productive. They'll supply meals in-house to their staff.
Right.
And that was called a convenience of meals situation. And the IRS allowed those type of meals to be deducted 100% in 17 and prior. Those have now dropped to 50%. And so there's a lot. I mean, in our accounting firm, I do that a lot. And so I'm going to lose a deduction there too.
Well, and you know what? I was actually listening on some of this as it was going into it. And the person who was talking about this, Clay, said that this was a slap at Silicon Valley. That specific thing you talked about, because that is a typical benefit that you see from the Googles, the Facebooks of the world, and we've all seen the videos or movies where, they just have unlimited food. You know, I think about the movie Interns where Vince Vaughn's up there, like at the thing, what if I got this? And they're like, yeah, that's free. And he's like, what if I took 2 of these? And they're like, yep, that's free too. And he's just like, I'll take 4 of those, 6 of those,
That's the convenience of meals. It's now been limited.
Yeah, so that was one of those things that they basically said, because they're not voting the same way Trump is that he basically took a slap at those companies who use that as a way to attract employees.
Yeah. I mean, so that is one of those things that's going to hit a lot of us. But the small business thing, that's how a lot of us network is entertainment.
Absolutely.
And so that is one deduction that, people have got to be aware of. And one other thing, a little caveat that kind of goes along with that entertainment thing that they did dismantle, I guess is a good word to say, is especially in the South, when you're talking about Alabama and Auburn, we go buy football tickets.
Right.
Well, we use them to entertain clients. Well, a lot of times to get those football tickets, you have to give a donation to the university, Tigers Unlimited, Tide Pride, whatever your university of choice is.
Right.
Well, those used to be a charitable contribution.
Sure.
Up to a certain point of, I can't what percentage it is. I think it was 80%, if I remember off the top of my head. That has now gone away as well.
Wow.
So that's going to affect the universities.
That's big money right there in Alabama, because the Tide Pride, in order to keep those season tickets, we're not talking small change. We're talking big dollars.
Right. And I don't know how it probably won't affect Alabama and Auburn just based on, the devout fans we are, but it could affect some universities across the country.
Yeah, that's really what I understand, that how some of these small universities actually make a lot of their budgets for these, non-revenue generating sports, is by taking in that money for that donation in order to get them to buy the football tickets.
That's right. Yeah.
We've talked a lot about eating. I'm kind of getting hungry. I don't know if anybody else is, but I'm really glad that you told me that we can still write off at least a portion of the meal, the meal piece there. But one thing, Clay, we were talking about before, I want to take this opportunity to have you speak on something you've shared with me before about kind of switching gears a little bit, not necessarily just a 2018 tax reform situation here, but from the standpoint of a step up in basis as it relates to estate tax and things like that. As you know, we talk a lot to our clients about life insurance, the value of that. And you have really shared some insights that I'd love for anybody else to hear about that. Do you mind sharing that as it relates to qualified plans?
Yeah, I would. The whole life insurance vehicle or investment opportunity, one thing I think that gets missed a lot in that vehicle is the tax ramifications of it, or the advantages of it, I guess is how I should put it. I guess the best way to do this is just give you an example. When someone passes and you have a whole life insurance policy and the beneficiaries inherit that policy, they inherit it tax-free. They pay no tax on that. And so you got to weigh that with some of the qualified plans. Let's say you have an individual that has a significant amount of money in a 401k plan, traditional IRA, whatever qualified plan that you want to name, and they pass and that money passes to the beneficiary. It is the only thing that doesn't get a stepped up in basis. They get it and they have to pay tax at it at ordinary income rates. Well, usually what happens in our experience is when you have a pretty wealthy member of a family that has several children, and they pass that 401k IRA to the children, usually the children, that child has come up in the same upbringing, has had a very good education, and at the time their parent passes away, they're pretty successful on their own, and usually in a very high tax bracket. So now all of a sudden they have to make a decision, and there's some things you can do, but at the end of the day, they're going to pay tax on that money that they inherit at their rate that they're in, and usually at that time, they're in the highest rate themselves.
So are you saying that that's one of the only assets that they don't get the benefit of when the parent or whoever passes the money to them, where they don't end up having to pay tax on whatever the value is at that point? That's the only one? If you own a 401k or IRA and you give it to your kids, you're guaranteed they're going to pay the highest tax rate on it?
Well, not necessarily the highest tax rate, but whatever tax rate they're in at that time, which usually, like I said in the example I gave, that's what we see. Usually the kids are successful themselves and are in a very high tax rate.
Well, I guess what I meant to say under highest tax rate, and maybe you can correct me, has there been a time when capital gains tax rates have been higher than ordinary rates?
Not in the
since you've been
several years. Yeah. Usually they're at around the 20% tax rate, and they have been for several years.
15 to 20%. You were saying most of the tax rates that people that are listening to this show are at 20% are much higher.
Yes.
So when I said highest, I didn't necessarily mean they were in the 37 or 39% tax rate. I just meant the fact that other assets, when they sell them, real estate, land, whatever, those may end up paying capital gains tax for any growth that they have in those assets.
Well, yeah, and the way that you got to explain that situation to people too, and it's a great tax planning strategy, because you hear so many of your clients, or in my clients, wanting to transfer assets right before the passing of of one of their parents. And it's sometimes you got to sit down with an attorney and a CPA, because sometimes that just doesn't make sense, because when somebody passes, there's still a stepped up in basis rule, which means, let's say they owned $1 million house.
Right.
Okay. But 30 years ago, when they originally bought it, they had paid 200 for it. Right. So if you transfer that asset as a gift prior to death, the person getting the gift takes a basis of $200,000, the original cost. Upon death, they get a stepped up in basis. So now their new basis in that property is $1 million. I know this is kind of technical, but they could sell it the next day after death and not pay a dime of taxes.
But if mom gives it to the kids a day before she dies in a gift and changes the deed, and then she dies and they turn around and sell it, they got to pay tax on the $800,000.
That's correct. That's correct.
Now, why I hear this all the time, because I don't know if it's just, I don't want to beat up on attorneys because they have they have to feed families and other things too. But I hear a lot of times that the attorneys are telling the parents to gift these assets to the kids before they die, and I've always wondered, like you just talked about, why would we do that if we got to step up in basis? Because a lot of the reality is most of the people listening to this show are very similar in age to the three of us. They've got parents in their 70s, approaching 80s, and maybe potentially a little older. And so this is a thing. Like, mom and dad, should I have them make changes in this? I'm just trying to figure out why. What is the justification there?
Well, sometimes, a lot of times, you'll have the attorneys suggesting that because it's a financial decision to make if the parents are going to have long-term care.
They're trying to get assets out of their name and things like that.
Assets out of their name, so now that they can have certain governmental benefits on helping paying the nursing home.
But isn't there like look backs on that kind of stuff?
There is certain look back periods that you'd have to get with your attorney. So I mean, there is some planning that the attorneys do in that instance.
And they're expecting all of that to go through
when they're out thinking all that to protect assets. But I mean, depending on how much assets you have, that might not be the most advantageous route to take.
All right, now pulling this back on track, because we kind of came into this talking about some of the changes that are happening in 2018. I appreciate you covering that, because that is a topic that we've been touching on a lot, is the use of life insurance. The fact, correct me if I'm wrong, it's income tax free, right?
That's correct.
If these policies are set up correctly, we actually can access money through the use of loans and never pay income tax on them, and then we can leave them to our kids or whoever our beneficiaries are without paying tax, right?
That's correct.
And right now, with the way the estate tax is set up, I mean, unless we have an estate, I think it went up to roughly $11 million per individual. I mean, unless we get past that, we don't even have to worry about an estate tax issue. It's hard for me to think that this isn't a good place for people to save money to use for their business. But bringing this back onto what we were talking about. Today, we're talking about tax reform of 2018, right? What are some tangible changes that you're sharing with your clients that you probably might make in this coming year or the next year, just based upon just some of the nuances that you found?
Well, one of the other things they've implemented that actually is going to help some of the pass-through entities, which is your LLCs, well, and any business, any sole proprietors qualify as well. It's just called a pass-through business deduction.
Right.
And what they've done for the taxpayer, they say for trade and business income, but with some of the nuances of the law, we think rental real estate income will qualify as well. Unfortunately, we don't know that yet. We're waiting on the IRS to give us the specific regulations to see if they'll qualify.
What do you mean by that? I don't think I understand what you said.
Under Code Section 162, you have a definition of trade or business income. And so your trader business is being a financial coach or an investment advisor. My trader business is being a CPA.
Right.
They've always said rental real estate is a passive income and not trader business. It's a passive activity.
Sure.
Well, based on certain rules that they put in with this new business deduction that I'm going to get to in just a second, they don't really clarify whether rental real estate is considered a trade or business for this deduction. But because of the exceptions that they put in, we think it will. But a lot of us are sitting back waiting until the IRS actually, write the actual regulations and clarifies it before we go through and say, hey, you can get this.
Yeah. So you're saying that potentially those who are making a living I mean, that's what they do is have lots of rental real estate. Potentially, there may be some deductions coming.
Yes,
out,
and
right?
they could get it too, and that's what we're hoping.
Okay, so what is this business deductions that you speak of here?
Well, in layman's terms, what it means, if you were to make $100,000, instead of paying tax on 100, you would pay tax on 80 because you got a 20% business deduction on your qualified business income. Now, there is all kind of limitations and expectations, like I said, that are going to keep us in business that we have to calculate for you.
Well, good. I mean, you need that, but you're saying that a lot of us who have businesses are going to potentially have some deductions because we have a business.
Right. Now, they did unfortunately exclude service providers like CPAs, you guys.
I don't provide a service anymore.
Yeah, but now the good thing is there is some exception to that based on how much income you make. So if you're making $315 or below, more than likely you're going to still get the deduction.
So they're going to help the new business, but the more established businesses, they're not going to necessarily get that 20% discount.
Right. So yeah, there's all kind of calculations that your CPA is going to have to do to see if, and that's one thing to keep in mind. We do a lot of tax projections for our clients throughout the year. And so you're going to have to sit down with your CPA. The last thing you want to do is overpay the government and then have a big gigantic refund coming back when you could have utilized your money up front. So you're going to have to get with your CPA soon after tax time, to make sure that your taxes you think you're going to owe.
And here's one of the things that it seems to frustrate the people that I'm talking to is we're sitting down, we're having a conversation, we're talking about what we're going to do with cash, and they say, I got to go talk to my CPA though, because I really have no idea what I'm going to pay in taxes, and I don't know how big of a check I need to start saving, using these concepts you're talking about. What do you tell somebody like that? How do you help them not be in a position to where they're like, I don't know what I should be doing. Like, I don't know how much cash I'm going to owe the government. Is there a process that they can implement that will help them?
Are you asking, how do you help your clients figure out, throughout the year how much to put aside for taxes and things of that nature as you're going forward?
Well, just at least to know roughly what they expect their tax liability to be. Isn't there an estimate out there that
yeah, we do a lot of calculations like that, and that's one of the things that we're trying to do for our clients. We tell them we don't want you to get caught with your pants down, come tax time and owe a bunch of money. And that's a good way to lose a client too, is when you tell them they have a big tax bill at the last second.
And they weren't expecting.
Then they weren't expecting. So we're diligently trying to get in touch with our clients saying we need your profit and loss statement or your financial statements sometime in the interim. Usually we like it at least twice a year, if not 3.
Yeah.
And then we'll do some annualization calculations from that income to see where we try to predict where their income's going to be, and then actually give them a dummy tax return.
Yeah. Well, yeah, you don't want an unsurprised or unsuspected or unknown, whatever the word is there, bill. It's kind of like that bill we just got for that ice maker there, Joey.
Oh, don't get me started on that.
Joey buys our office being uber conservative with money over there. This guy is tighter than anything. He buys us a used refrigerator for the office. Russ, I got us a deal here.
What a deal.
I mean, he paid $300 for a side-by-side, with the water and ice in the door and everything. And he's so happy with himself. He just can't express. He knows I would have went and spent $1,000 and bought this thing. And, of course, a month into the deal, the ice maker breaks, which I drink water all day long. So here I am like getting ice trays and stuff. I'm back in the 80s with this deal. Well, he finally tells me as my New Year's present, he's going to get the ice maker fixed. I'm like, yes. So the guy comes yesterday, fixes it up. I mean, he was here a total of 7 minutes. I mean, if that. He walks out and sends us an invoice. I look at it. $369.
More than we paid for the entire refrigerator.
Yeah, well, I wish I could make that an hour.
By the way, Jim or whoever you are, if you're listening to this thing, I'm pissed. Okay? Try to slide a fast one on me, man.
He slid one on you, I can tell you that. Well, Clay, I know that you got to get back to the office. It's 5 o'clock here, but that doesn't mean that you get to stop. You got to go back, I'm sure, and get back after it. I want to make sure that is there anything else that you were going to share that, I'm sorry, I derailed us with the ice maker discussion there, but anything else that you thought would be worthy to share or a question that you've been answering?
Well, the main thing is, with this tax reform, don't take it lightly. In other words, once you get through your tax return filings, which probably will happen in March and April, and that all settles down, get with your CPA and see if there's anything to do, because there's other nuances that that we haven't been able to talk to about the show that affects different types of businesses. And so you've definitely got to get with your CPA and see how these can benefit you and see if there's something you can implement.
Yeah, well, I will just say thank you again, Clay, for being on the show. I hope that you'll be willing to come back after tax season, and maybe we can see as different things are changing and progressing in the tax reform issue that we'll be able to continue to clarify it. And by the way, you always have been gracious every year to give me this like tax organizer, which helped me figure out all of these different things I need to pull together. Would you be willing to let our audience have access to that?
Absolutely. I can PDF a copy of it, send it to you, and
all
then
right.
you can be glad to share that with somebody.
Awesome. Well, then what we're going to do is if you'll go to www.wealthwithoutwallstreet.com, this is episode 17, that's 017. In the show notes, we're going to offer that as a downloadable item that you can get. And also any information that we've already shared in this, we'll be glad to throw that in there for you. Thank you, Clay, again for coming, and thank you for listening.
Russ, what a great interview today. I can't tell you how grateful I am that Clay could take time out to help us answer these questions. You and I have been talking about them for weeks now.
Well, and I know that, there was lots of things that came out of that, and there's still a lot of fogginess, right? And
that's right.
I guess that's why we pay people like Clay to be able to sit through those 4-hour conferences and figure out that kind of stuff, because I'm not going to do it.
Yeah, don't sign me up for that one. Now, this was a little bit of a laid-back episode compared to next week's episode.
Yeah.
Let's just put it this way. You get a little hot under the collar about one of the nation's financial gurus, as they say.
Oh,
but
guru? Yeah, right.
He's peddling garbage, as we're going to uncover.
If I listen to anyone talking about things that are just untruthful, I'm just going to have to bring some light on that one. And this next episode, we're going to get into it. And it's not just going to be opinions. It's going to be based on math and facts.
That's right. We're talking about Dave Ramsey. Here's just a little taste of what you're going to get next week. We're passionate about giving you the truth. So we're not just telling you these things. We're backing it up with numbers. You can physically see them with your own two eyes. You can even use the same calculators that we use at truthconcepts.com. So get a copy of this and please share it. Share it with other people, especially those people that are just gung-ho. Hey, Dave Ramsey is the only one that I listen to. He's a great guy, but he is very misled on this. And the last thing we want is people looking up in 30 years and saying, wait a minute, this isn't what I signed up for. I got to continue to work now. I can't take my foot off the pedal. I've got to continue to provide for my family because the investment strategy I was employing, it failed me.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your terms in places you understand so that your wealth will never run dry. See you next episode.